The 360 on Energy and Carbon podcast, hosted by 360 Energy. Sheldon Fulton has been a consultant in the Canadian energy sector, specializing in the design and implementation of markets for the past 25 years. Mr. Fulton's ability to draw on 50 years of experience in commodity market analysis, automation of commodity exchanges for a diverse range of commodities in various international markets, provides a unique perspective for the Canadian energy markets. Mr. Fulton is president of Forte Business Solutions. Forte provides consulting services to the energy and agricultural markets on economic and market issues. Now let's get into the episode with Sheldon. Welcome back, Dave, John, and Sheldon.
Thank you, Lysandra.
All right, we're back to the overlapping. No cues this time.
Yes. Yeah, so finally we overlapped again, John. That's great.
It's a trademark.
Well, Sheldon, we're really excited to have you on again for this episode. Today we'll be talking about an Alberta case study that you did. And to kick off this episode, how did you get involved in the Alberta electricity market?
Yeah, well, thanks again for the invite. And it's a bit circuitous, but I'll try to keep it as short as I can. So my own background is in markets for, as you can see, for a long, long time. Originally in the grain markets and agriculture out of Manitoba, got involved with computerizing commodity exchanges. So we originally did the Winnipeg Commodity Exchange and then did two exchanges over in London, England. John, a couple of times over there, and then one in Australia, and then eventually the after-hours trading system with NYMEX for trading oil and gas. And as a result of all of that, over a period of about 20 years, got invited to put together a market in Alberta for natural gas. And it was a first in two different ways. It was a natural gas exchange that was proprietary. So it wasn't a public exchange. It was owned by a company, West Coast Energy, and it was totally electronic. There was no floor, no other aspects of it. So it was all the component pieces that you would put into an exchange for trading natural gas. And it was a physical contract. We were trading gas on the pipeline and clearing that gas. That exchange is now the paramount pricing structure for physical natural gas in North America. There's the futures contracts traded in New York, and there's the gas contracts traded basically by NGX. As a result of that, we were into deregulation in electricity in Alberta. So moved from Winnipeg to Calgary and got asked to look at how do you deregulate? How do you create a deregulated environment for electricity? And was working with a number of companies that I had met during the oil and gas phase of putting that exchange together that were interested in what are the elements of electricity with respect to it being deregulated and what did it mean to them. And so these were largely companies in the oil sands projects that needed to have an electricity supply as well as steam supply. And so my beginnings in this particular were looking at those aspects of it as being part of the deregulation discussions on behalf of the industrial consumers of electricity in the province.
So you may have answered part of this, Sheldon, but the question is, how was the Alberta electricity market initially set up? How was it formulated, and how did you come to grips, or people come to grips with how the logistics, the dynamics, how the market was going to go?
Right. So this was classic late 1990s, end of the decade or end of the millennium, I guess, in this case. But we're looking at, let's look at markets. Markets, are being touted as the solutions for things. And at that time, as we've always had in this province, it seems there was a conservative government that said, we like markets, coming out of the Ralph Klein era, we need to deregulate, liquor stores and all the rest of it. So let's deregulate the electricity sector as well. And so the motivation was to deregulate a regulated sector and to create a market. Beyond that, Dave, they didn't do a good job of setting out what did they want to achieve. They essentially said, we'll let the industry decide. So we'll bring together all of the generators into a room, and it will invite some of the buyers to that activity, and they can talk about it. So you go to a meeting for market design, and it would be populated by the TransAltas and the COs and the big companies that were already involved as utilities, looking at protecting their preserve, which is what they're supposed to do. And there would be two or three of us that were representing the buy side of the market. And in this case, I was working with the industrial consumers. The regular, residential consumers had a couple of people that would appear at the meetings, but there was no balance with respect to it. So the design was to, quote, deregulate a regulated sector, but not having a lot of really clear objectives. And so we ended up with things like a pricing mechanism, which we talked about in the previous segment, a pricing mechanism that was largely designed to dispatch coal facilities, because 70% of our electricity was coming from coal facilities. So let's design a market to send a price signal to dispatch that, not looking at, well, what do we really want to do down the road? So the deregulation was left to the industry to make decisions without really good overguiding principles and without a proper balance scale between the buyer and the seller. So no equilibrium elements to it from that aspect. But we went ahead, we deregulated, we created a new market. Interestingly enough, if you think about it, both Alberta and Ontario looking at doing similar things. Neither one of them actually called it a market. It's the Alberta Electricity System Operator. That's the one that runs the market. There's no M in there. And that's part of the problem, is that all they were really doing was looking at, how do I continue to do what I used to do in a regulated environment, except now, if I'm lucky, I can make even more money than I used to.
Just to follow up on that, Sheldon, did there reference any markets? Like I think the UK was deregulated before. Was there any reference to any of those electrical markets prior?
Oh,
Like
yes.
did you? Okay.
Yeah, the consultants had a heyday. So almost all of the deregulated markets that were occurring. So what was occurring in the UK, the deregulated markets, California, the activities in the US Southeast area, all of those deregulated markets were being reviewed at the same time. And, quote, input was coming from them. And this is what's interesting in the Alberta case, is that unlike any of those other jurisdictions anywhere, over 80%, something like 82%, we have an environment where utilization factor is at 82%. So 82% is the average amount of consumption in 24 hours. So we have very, very little peaking. The difference between our low point and our high point is less than 20% over a year, not just on a day. So we don't have a peaking environment, but we were borrowing all these ideas about, well, you need to have pricing signals that deal with triggering demand response. We got to reduce the demand. We got to do a lot of stuff that wasn't a problem. And the pricing process that we developed was borrowed from those other environments without really going back and saying, well, let's analyze what our commodity looks like and what do we really want to achieve? What are we trying to do? What are we trying to incent with respect to it? And so the difficulty was that we were borrowing concepts from markets and then pretending that they were better than what we were getting advice on locally from the industrial consumers and myself, is that, well, you don't know what you're doing because you've never designed an electricity market before. So where do we go from here?
Interesting.
Thank you for that. I suppose the next part of this is to understand. So this market was set up in the late 1990s. So what has happened over the past 25 years to bring the market to where it is today?
Yeah. So, and that's a good one, John. And that's what, I mean, every good market design is continuously looking back at what it's doing. I mean, there's a perception that we've been treating corn and wheat in North America exactly the same way for the last 100 years. Well, I can tell you that's not correct. Those contracts and the processes by which they transact and dealing with a whole bunch of other issues are continuously changing. And the feedback loop that comes as a result of what do we need to change is what causes the contracts and the pricing mechanisms to change. Well, we broke the feedback loop, if we ever had one, in electricity. We started a system and it was designed to do, dispatching coal facilities. And in 25 years, we've phased out all the coal facilities essentially in Alberta. We have a couple of what are called dual coal or in the process of being converted to natural gas. So we have less than 8% of our capacity is coal compared to over 70% 25 years ago. And the big difference with coal is that they're big facilities. They got to be located by the mine. They got to have a transmission system, and then you have to have a distribution system to move the power out to where it needs to be. What's changed is that we've moved to over 70% natural gas, which is really an ability to move the generation beside the consumption. And a big chunk of that, about half of that, is in oil sands projects where you need the steam, you need the electricity, and you just locate it right beside where the oil sands are. We also have done that to an extent in terms of large scale natural gas like the Calgary Energy Center, which is an 800 megawatt generating facility just outside of Calgary. And we're increasingly populating the generation closer to where the consumption is. We haven't fully embraced the ability to produce it with a smaller facility than that, but we're moving in those directions. The other big change that we've had is that we've changed the mindset with respect to renewables. And Alberta has three basic renewables. It's got it's got the wind generation, and we have if not the best, one of the best wind resources anywhere in Canada, maybe North America. We have solar, which is, we get a lot of sunshine like we got behind me right here. And solar is a very good element of it. But we also got a whole mess of mountains just to the west of here. And moisture has a tendency to flow down from the mountain relatively quickly. And that's a pretty good thing to harness from a hydro perspective. We've done a very poor job of harnessing our hydro capabilities in this province for whatever reason. But notwithstanding that, we've got three different aspects of renewable generation, which 25 years ago, you had to have two separate sessions. You would have a renewable electricity group that was meeting and talking about stuff, and then the rest of the electricity industry was just saying negative things about them. Well, it'll never happen. Well, you can't dispatch electricity from a wind facility. Every harm that you could think of that you could create as an obstacle was created as an obstacle. And it wasn't until probably 10 years ago that we finally started to think, well, maybe there is something to this carbon reduction aspects that we need to do. I say 10, it was probably 15 years ago. And so Alberta actually pioneered a process of allowing for carbon offsets to reduce the carbon footprint of what you were producing from large scale carbon generating units like oil and gas and electricity. So I could buy an offset from a wind project. I could be a renewable energy certificate or an offset or something of that nature. So we had this happenstance where the market decided that all of a sudden there was value in having these offsets with respect to it, way before it became popular to talk about it anywhere else. 2007 was the first time. It was called SEGR, specified emissions generator regulations. So it was designed to be able to recognize value with respect to offsets that are there. So as we move through these 25 years, we started to have some new aspects come into play. We also had the highs and lows of what we call the retail market. So when we deregulated electricity, we deregulated it at the generation end. We created a price. We continued to regulate the connection between that generation and the consumer. And then we deregulated the consumer. We said, well, you can buy it from multiple retailers, but we're only going to have one price discovery mechanism. So all of those retailers are pulling their price from the same pricing signal that's there, which is this hour by hour market that we had created to dispatch coal units. So we had a deregulated electricity market. In 25 years, there's still 40% of the customers have not signed a retail contract. And the reason that the bulk of the ones that have signed with their local utility. So ENMAX has something called EasyMax. So they just transferred their regulated customers to their EasyMax customers so they could say that they were, quote, successful as a retailer. But we have no effective retail competition from that. And it's now at a crisis stage. And that's, I think I'd mentioned it in the previous session that we had done, we've now had to cap our electricity for Jan, Feb, March of 2023 at 13 and a half cents, which is record high pricing for Alberta, because what was being filed as the rate for consumers was twice as high as that. So we've got this convergence of problems over the 25 years, John, that we just are not dealing with and are not looking at any effective discussions to deal with it.
I want to pick up real quick because just for our listeners, when you're saying 13 and a half cents, that's strictly commodity. That doesn't include transmission and distribution. Is that
No, it's
correct?
not.
Yeah,
No, it
that's
does
just
not.
commodity.
I mean, that
Yeah,
13 and a half cents is just the price of the commodity, and that
that's right.
price of the commodity is about one third of your bill.
Yes,
So
yes.
we're paying close to 40 cents for our delivered electricity in this province. We're getting
Yeah,
close to Ontario.
I wanted to make sure our listeners, because when they hear
Yeah,
13 and a half cents,
my
they may
error.
go, that's not too bad. But no, that's just one third of the price.
Yep.
So Sheldon, the one thing that you conveyed, like, I said this in the earlier podcast that we did with you, that, I like markets because you tend to get end use customers have choices and you get price discovery. And then the only way that happens is that you create competition. Like you have to have a number of players in the marketplace. And what I heard in the last piece that you just said is there really isn't competition. So my question to you is, like, based on what you know now, what changes? Like, let's say you got a clean sheet. What changes would you do to improve the electricity market? And we can talk about Alberta. I mean, for our listeners, Sheldon just released a paper conveying some of the challenges in that marketplace and what could be done. So we'll put that link in this piece. But I'm really interested as a market designer. What would you do differently now to improve the electricity market? If we have time to talk about Ontario market too.
Yeah, it's that third component. We go back to the previous session. If you remember, I talked about, the price message. So what price signal am I trying to send? I talked about performance between the buyer and the seller, but the third one I talked about was risk. And every good market is ultimately driven by risk, and it's that balancing of risk between the buyer and the seller. And in the absence of governments interfering, it's allowing that risk to do what it's supposed to do, which is to cause different activities. So that if the purpose of the price signal of a well-designed market is to say, I want more electricity from low carbon intensity generation and I want it reliably, so that's my price signal. What I now have to do is say, well, when I design that, I have to put somebody at risk for failing to perform. What that means is that if I'm an investor and I can find a way to make investments that allow me to sell that product for the premium, he can't succeed. We would have phased out coal in Alberta 10 years sooner if we'd really put the coal guy at risk to his inability to be dispatched other than by, a pricing signal that every minute, and his inability to lower his carbon footprint. And ironically, you mentioned, Dave, that Ontario solved their carbon problem with coal by simply closing the plants. They didn't really put them at risk to the market. They just said, well, we're going to phase them out, so we're going to close them. But that was fairly easy because you had a public utility that you could pay off as a result of that consequence. A good market doesn't allow public money to pay off the failures from that element of it. And so I guess the kinds of things that we need to be doing need to be thinking about the components of that market. What price signals do I want to send? Who do I want to incent with respect to that? And then that says, well, in the middle now, I need a new pricing mechanism that's going to deliver that. And so the current pricing mechanism, which favors those guys that can at the last minute, push the price up to $800 or $900, you got to take that advantage away from them from that perspective. And that means you got to put them at risk. And the way to put them at risk is to push them into the forward market. So you have to make a commitment to sell a day in advance or a month in advance. And if I buy power from a wind generator because I want his renewables and I want to strip off that carbon intensity coupon, I have to compensate him for his inability to be dispatched. And so he needs to go make a deal and pay for that somewhere else. He needs to be at risk. But if all he has to do is sell me the power and he's not at risk to delivering that power because it's all squared up in some kind of a mathematical algorithm, which is the way we settle all of our markets, nobody's physically at risk. They're only financially at risk. We take away the strongest lever that markets have, which is the ability to ensure delivery performance of that particular contract. Every single electricity jurisdiction has done it. But if you look in the commodity markets and you look at what goes wrong, it's the physical inability to deliver. I can't get a ship to get there. I got traffic problems. I got the rail lines are down. They're all physical problems. And if we take away, and electricity has a ton of physical problems, bad weather, all kinds of things can affect your ability to deliver. If you get to just smush that, you just say, well, we'll just collectively add all that up and make the buyer pay for it instead of making the guy that's trying to do it at risk, then we do away with that big driver that's in the market. That's the biggest single missing piece in the current design of markets is the inability to make the person that's selling you the product physically responsible for delivering the product.
So just quick follow-up. What you described, is that happening in other commodity markets, like in agriculture? Wheat.
Oh, absolutely.
Okay.
And Dave, remember, sorry, I didn't mean to interrupt, Dave, but
No.
remember I talked about the reason I first came to Alberta was the natural gas market. And what we did when we were putting this market together, we had first off West Coast Energy, which is the biggest pipeline outfit in BC at the time, but also, a relatively large player in the market. But we worked with Nova Gas Pipelines and currently owned by TransCanada or whatever their new name is. And so Nova Gas Pipeline says, hey, we have something called line pack. People can put gas into the pipeline and they can take gas off the pipeline, but they have to stay in balance. So we measure whether they're taking more off than they're putting in or whether they're putting more in. So line packs or line drafting. And they measure that on a daily basis. And I said, hey, this is really good. We'll trade that line pack. We'll trade the physical ability for these guys. And if they can't deliver, they got to go and buy it and put more gas on. Or if they take too much off or not enough off, then they're held accountable for it, that physical delivery. Every well-functioning physical market has that physical delivery risk or that risk of performance with respect to it. And we have a tendency to say, well, if you look at the math, a financially settled contract is the same as a physically settled contract. Then we're all forgetting what happened, I think it was in March or April of 2021 here in Alberta when literally the oil price went negative. We had negative oil. It made the news everywhere in the world. You even saw about it in London, John. Negative oil prices. Well, why did we have negative oil prices? Because nobody could make delivery, and anybody that had oil in store wouldn't sell it to them. They just kept driving the price down to nothing from that perspective. And so that's the consequence of it. And I can tell you that's never happened again since then, probably won't for another 4 or 5 years, because people will do everything they can to avoid it because it will bankrupt the company. We don't allow bankruptcies in electricity. We should, but we don't.
Thank you for that. I think it falls to me. In the first podcast, I asked you for top three, and you said you got two top threes. So I'm going to give you the same option here in this one. What's the top three things we can learn from what Alberta has got wrong?
Right, John. So I'm not going to revisit creating 9 new lessons. I'm going to go back to the 3 of the ones from that initial list, which I think are critical things that we need to understand. So the first one is, what price signal are we trying to drive from the commodity? So what is the commodity definition? What am I actually transacting? Am I transacting electricity minute by minute? Or am I transacting electricity from a renewable source? Or am I transacting electricity from a secure source, or all of the above? Can I plug in those different attributes and define a commodity that the price signal is going to be, quote, my optimum signal? It's the one that I want to send to the investor, and it's the one that I want to send to the consumer. And I want to have as maximum as I can, consumers making choices and investors making decisions. The second piece is the way that I determine that price. What mechanism am I going to use for creating that price signal. Right now, we have a system that says every minute we calculate a price based on a stack of offers, and then we look at, well, what do we think the demand is going to be? Where does it cut that stack of offers? Oops, that's the price. Everybody that's in the queue, doesn't matter what they offered it for, all get exactly the same price. So we have a single pricing mechanism that rewards everybody that decided that they were going to have a facility. And I can go back into the history of why that got designed. It was all based on these coal units that had to be dispatched, but they're all gone, and we don't need that mechanism anymore. So we need a new pricing mechanism, and it should move itself into the future. It should be saying, I want a clearer price signal as to what it's worth for my optimum commodity that's out there. So I want my primary price signal to be the day ahead or the month ahead or some time frame from that aspect of it. And then the third part of it is I need to rewrite the rules and procedures with respect to what governs performance of those contracts, both from a pricing perspective. In Alberta, we have something called the Market Surveillance Administrator. It was a group that was set up to specifically oversee the electricity market in Alberta, not the Securities Commission, not the Utilities Commission, but a separate group. They came out with a report about a year or so ago saying the market's essentially not working properly. We have a concentration of market power. That concentration is over 60% controlled by two entities, the price, on a continuous basis. And they were told that they couldn't do anything about it by the government. No, you can't interfere in the market. So you can put your report out, but we're not going to do anything with it from that perspective. So we have no punishment on the rules and procedures side for bad actors in terms of manipulating the market. And we don't have any good rules with respect to what constitutes performance for delivery of a forward contract, because we don't have any forward contracts. They're just financially, mathematically settled contracts against that minute by minute price.
Thank you.
All right. Well, thank you for another great episode, Sheldon. To end off this episode, what is the biggest takeaway for our listeners?
I think the biggest takeaway is that we need to analyze the outcomes of the last 25 years in the Alberta market. We need to do the same thing with the Ontario market. It's made a lot of mistakes as well. I did spend 3 years in Toronto with the Ontario Power Authority looking at how do we redesign the market in Ontario. Unfortunately, most of that's gone by the side. The changes aren't occurring. Every jurisdiction is now wrestling with this issue of how do I make electricity the primary driver in meeting net zero requirements in another 30 years. And yet we're not doing anything about the fundamental nature of how that electricity is being priced and sold and incented and discovered and everything else that a market needs to do. So we need to just have politicians and regulators and the average person that's on the street looking at getting change saying, I want to go back to electricity. I want to look at how it's structured and how do we move forward from here? How do we properly harness it as a major tool in achieving what we want to get for our next generation?
Thanks, Sheldon. Dave, what's your biggest takeaway?
I think Sheldon stated this quite clear, and that is just because you develop a market doesn't mean you don't look at modifying and changing the market on a continuous basis, because the market changes and conditions change. So you need to be mindful that that has to be revamped and changed. You can't stay with the status quo. The other thing that I want to reinforce is if we want to get to net zero, the current status of how we manage electricity, we're not going to make it. It's just not going to happen. So in summary, I think the electrical markets are going to have to turn upside down, and that will be monumental because of the people that are currently there and what they like and what they don't like. But I think that's the biggest thing. These markets, they're really efficient. They're very effective if you design it correctly, but you actually have to let the market happen and you have to redesign and evaluate all the time.
Thanks for that, Dave. John, hopefully Dave didn't take away your biggest takeaway.
It got close. I think what's got reinforced this time around for me is the third bucket, the risk bucket, of about how important that is. And if there isn't real risk, then why do you do something? And I think the other thing is, and it does slightly touch on what Dave was talking about, somebody somewhere needs the courage to make changes.
I just want to have a second chance at having my final word. So
Yeah.
the
Go for it.
I put it into the paper that was referenced earlier in Alberta. In the last 2 years, we've seen the highest prices by a long shot that we've ever seen in electricity in the province. And that's reinforced by the Market Surveillance Administrator's report. So anybody wants to go and have a look at those can go and have a look at those. My calculation was there was a $10 billion wealth transfer from buyers, consumers, to generators. My question to you is, in a properly designed market, did that $10 billion go to the right person? Did it go to do the kinds of things we wanted it to do? And $10 billion, even in Alberta, is a lot of money. So there's $10 billion worth of value taken away from consumers and given to a few companies that are doing what with it to, quote, further that whole process.
Thanks for that, Sheldon. All right, another great episode. Thank you all for your time today.
It's been a pleasure.
Sheldon, really appreciate
That's
this.
it,
We've been trying to get you on for a while, and I'm so glad we had you. So thank you
Yeah.
for being our guest.
Yes, well, I appreciate the opportunity.
That's all for today's episode of the 360 on Energy and Carbon podcast. Thanks for listening. Make sure to check us out on our website at 360energy.net and follow us on LinkedIn at 360energy Inc. Tune in to our podcast on Apple Music, Spotify, Anchor, or other listening platforms by searching the 360 on Energy and Carbon. You can watch the video recording and subscribe on YouTube at 360 Energy Inc. Email us your feedback at podcast@360energy.net or comment on our LinkedIn post. See you next week.